We saw revenue and earnings beats from 5 of the Magnificent Seven. We're talking Microsoft, Amazon, Alphabet, Apple, and Meta. Did these reports, did they justify the lofty valuations for some of these names? I'm looking at Amazon, 79 times forward earnings. Alphabet only 22 times, but the S&P trades at 20 times.
Well, look, I think one of the things you saw across big tech was that the companies were harvesting the cost savings that they made at the end of last year and early this year. So you saw record margins at Apple, a recovery in earnings at Google, and a huge earnings swing at Amazon. So in a market where there's not a lot of growth to find in the consumer, based on your previous segment, currently credit card debt and other things are weighing on the consumer, these companies have only one path to take, which is to control their own costs. And you saw that show up in earnings. Equally, when you look at the 5% decline in Apple on Friday, you've got to set that against, as you're showing in the chart right now, a 50% gain this year, which, you know, annualizing a 6-month 50% gain in a share price is pretty punchy.
All right, fair enough, but you didn't really answer the question. So from what you saw, are these valuations justified? A lot of people talk about stretch valuations. We mentioned it in our wall of worry. After these reports, can you see a justification for a stock like an Amazon to be 79, 80 times forward earnings?
I think in most of the cases of big tech, you would see the valuations justified by the duration of earnings. What you're seeing in the Apple ecosystem is that it stretches out maybe even a decade where people will continually be buying the products. If you look at an Amazon and you compare that with the other e-commerce companies in the market, they are able to grow and continue to bring in new sales. They were growing their advertising business, a $40 billion run rate business at 20%. The cloud business continues to grow in double digits. And they can't do that much about the consumer, but it's the duration of earnings at these companies. And Microsoft is another great example. The embedded position they have in enterprises, we're seeing stabilization in software spend.
So
you
sounds
know
like a long
Microsoft
answer for
isn't
yes.
going to go away.
Sounds like a long yes. You feel like it's justified with what you're saying. Okay. I want to talk about the markets overall. Mega cap tech makes up nearly a third of the S&P 500 market cap. So if we see a pullback in these stocks, what does it mean for the overall year-to-date rally?
Well, I think what I'd be more concerned about is with some of the second-tier companies, because it's clear that they're losing ground to mega cap big tech. And what we see coming with AI, as you talked about, is really a battle for resource. The mega cap tech companies are going to have the money to spend on the compute infrastructure that everyone is going to want to use for AI. And indeed, they are propping up the market right now. I don't think you can divorce the wider market from what happens in mega cap tech, but I think you would be more concerned about the second-tier companies, some of which are just coming into profitability right now and now need to be valued like real companies. And a lot of them, frankly, are a lot more expensive than mega cap big tech.
Okay, that's a fair point. I think you're talking about cloud names, some of the names in the ARKK ETF. So when we talk about those names, we saw a pretty sharp pullback when rates went back above 4%, right now at 4.10% on the 10-year. If we continue to see that rate pressure, mega cap tech, maybe that trend continues to go to the upside. But are we going to see a sell-off when it comes to what are generally considered riskier areas of tech?
Absolutely. I mean, I think if you see those companies that are either moving just from losses into profitability, the Ubers and the Spotifys, they'll need to be judged like real companies now. And you see a whole cadre of other companies that still haven't crossed that Rubicon into profitability. Now, the one thing you can say about mega cap tech, with maybe Amazon as an exception, is they're all sitting on huge amounts of cash. Google has over 100 billion, Apple has 60 billion, and so on. So these companies can continue spending in an environment where capital gets more scarce and widen the lead that they have over some of these smaller companies, which are reliant on the market to prop up what are clearly pretty punchy valuations, even relative to big tech.